This is Chris Casey, Managing Director with WindRock Wealth Management. Today we're pleased to have Adrian Day join us. Adrian is a British-born writer and money manager, a graduate of the London School of Economics and president of his own money management firm, Adrian Day Asset Management, where he specializes in global diversification and resource equities. Adrian also manages the EuroPac Gold Fund, the top-performing gold fund in the first half of this year. And Adrian, correct me if I'm wrong, but I looked at it earlier today. I think it was up 112% year to date. Does that sound about right?
That sounds about right, but I try not to get too excited day by day.
Adrian's also been a frequent guest on CNBC and Wall Street Journal Radio. In addition to his two books on global investing, his latest book is Investing in Resources: How to Profit from the Outsized Potential and Avoid the Risks. So, Adrian, today we're obviously here to talk about gold. Maybe we should start off with the most basic of questions. Why should people consider owning physical gold?
Well, thank you for having me, Chris. Good to be here. You know, that's an excellent question, and sometimes we, as you say, we don't get back to basics. You know, I think people should own physical gold primarily and first of all as an insurance policy. Gold is an insurance on the rest of an account, and gold tends to perform well in terms of crisis and turmoil when other things are not doing well. And you know, people often think of it as an inflation hedge, but in fact, it's not only an inflation hedge, or not primarily an inflation hedge in my view. It's a hedge against monetary instability, and you know, inflation can lead to monetary instability, but sharp deflations are also positive for gold.
Would you agree that we probably just saw that with the aftermath of the Brexit vote from a few weeks ago?
Well, absolutely, yeah. People are concerned about the uncertainty, and you know, Brexit does have a certain degree of uncertainty about it, no question. I think a lot of the predictions are grossly, you know, overdone, to be honest. But certainly there's uncertainty, and there's uncertainty for Europe, and that's a positive for gold. And gold has performed this function, you know, for many thousands of years. This isn't new. So that's the primary reason, in my view.
You know, gold, it's in the news right now, and a lot of people are starting to talk about it simply because of its massive appreciation this year. So we have gold up, depending on how you measure it, I'm guessing around 25%, and silver's up even more, about 45%. What's behind these dramatic moves in 2016 alone? Is it solely the uncertainty, or are there other factors at play?
Oh, there's certainly other factors. I mean, first of all, let's talk about why gold is up, but then also why it's up so much. I think the monetary situation and the monetary is definitely a key component. And when you think back to December, the Federal Reserve increased the Fed funds rate for the first time in many years in December. And they actually predicted, the Fed Open Market Committee itself predicted 4 more interest rate hikes this year. And they started backpedaling on that very, very soon. And I mean, that's clearly not going to happen. And so I think the market is saying, well, money's going to remain easy for longer than we thought. But more than that, I think the market is beginning to realize that the Federal Reserve and other central banks around the world really are not in control. And I would go even, if they ever have been, and I would go even further and say that the Fed, particularly under Bernanke and Yellen, really has no clue what they're doing. That sounds a very extreme statement. But I would say that they're really clueless about what's really going on in the economy, but how to deal with it, and their power to deal with it. So I think people are beginning to realize that the emperor has no clothes, and that's very, very positive for gold, because gold is really the antithesis of central banking. Greenspan used to famously say that he watched gold as a barometer of how well he was doing. And if gold was going up, he knew he wasn't doing a very good job. But as long as gold stays subdued, he thought, everybody likes what he's doing.
What do you advise? I know you can't give particular investment advice to any listeners of this podcast, but in general, what do you think is a healthy allocation in anyone's portfolio for gold and maybe gold and its associated products like gold stocks?
I think an awful lot depends on the client. That's obvious. I'll make two broad comments. One is, if you're looking at physical gold as insurance, then the question is, how much insurance do you need? And just as different people at different stages of their life and in different circumstances need different amounts of life insurance, let's say, different people in different financial situations need different amounts of financial insurance. And if you've got 75% of your portfolio, I had a gentleman once, 75% of his portfolio was basically treasuries, municipals, and banked CDs. Did I think 25% of his account was too much for gold stocks? And I said, well, not if 75% is in treasuries and cash, So a lot depends on how much insurance you need. Beyond that, when you get to the stocks, you and I both know that gold stocks are very, very volatile, inherently volatile, both on a long term and on a short term. And you cannot avoid it. People try to avoid it by using sell stops and buying puts and doing all sorts of things. But they are volatile, both on a long term and on a short term basis. And the answer to the question, in answer to the question, I would ask another question, which is, how well do you sleep at night, basically? And a person's got to really understand and ask themselves if they can live with volatility. Some people can live with volatility, and if you can, and the rest of your portfolio is relatively conservative, and you don't need the money immediately for anything, you're not going to need the money on a moment's notice. I have no objection if people have 25% of their portfolio in gold stocks. But if you're a nervous Nelly and you're constantly needing little bits of money from your account for this emergency or that emergency, you don't want to be exposed to volatile stocks. So, it's difficult to answer the question without knowing a person's circumstances. But right now, I don't know about you, Chris, but right now, from an investment point of view, I would say if we look ahead 2 or 3 years, I would say the gold stocks are probably likely, and I emphasize probably likely to be, one of, if not the best performing asset class over the next, 1, 2, 3 years. And silver stocks may do better, but as a broad category for precious metals. And if that's the case, you want a fairly healthy allocation.
Right. I think we would agree here at WindRock.
One other thing, if I may, sorry. When you asked me about gold's appreciation, what's behind it, I mentioned the monetary situation. But the other thing, why gold has moved quite so fast, so quickly, is simply because so many people, retail and institutional, are underweight gold. And that is a very, very big factor that should not be ignored. So a lot of people say to me now, oh, gee, Mr. Day, have I missed the rally? Not at all, not at all. This is just the beginning. And you look at gold's resilience this year. We haven't had a decent pullback or correction since gold took off at the end of December, and that's because there's so much pent up buying. I think. I'm sorry, Chris. I had to throw that in.
No problem. Let's talk about someone that's thinking about buying gold and has never done it before. Maybe you could kind of walk us through the decision tree someone faces. So, in my mind, if someone's going to buy gold, they first have to determine whether or not they want to own physical, let's say, versus something, the so-called paper gold, something that mimics the price of gold, like certain gold ETFs. And then it becomes a decision of, okay, if I am going to own physical, what form do I own? Is it bullion? Is it coin? If it is coins, which kind? And finally, where do I physically hold it? Could you kind of walk us through that kind of decision tree for a new buyer?
Yeah. Okay. Well, I would say to start, one should always start with as close to pure physical gold as you can get. And every time you deviate from pure physical gold, you are taking on some kind of additional risk in addition to the price. You're taking on some kind of risk. Now, if you buy, what are called bullion coins, you're taking a very, very, very small risk in addition to physical, bars. In fact, physical bullion coins are really the same as physical bars. But if you're buying, as you deviate from physical gold, you take on a risk. If you buy a gold ETF, for example, and I am not as nervous of the gold ETFs as some people are, but if you buy a gold ETF, you're clearly taking on some risk. There's costs, additional costs over the cost of just storing and insuring bullion. There's an additional cost which comes from, the very small management fees that the ETF charges. But you're also taking a risk that the gold may not be there. It may not be there when you want it. Maybe, etc. If the government wanted to confiscate gold, they know where the ETF gold is held. They may not know where your gold is held, etc. And the further you get away from that, numismatic coins, in a very general sense, will go up and down with the price of gold over a 5 or 10 year period, but they can have very, very exaggerated moves based on the rarity factor, and so on. And the same with, obviously, gold stocks. You're taking on management risk and everything else. So I always say to people, start with physical gold, and if you can afford it, buy physical bars of gold. The storage is a different issue. You have to store it somewhere, and wherever you store it has a risk. But and then if you can't afford that, buy some physical coins, 1 ounce coins, half ounce coins. And only deviate from that once you've actually got the physical gold.
Great. Well, let's talk about, you mentioned the gold stocks several times, and you mentioned they're more volatile than gold itself. I mean, if you look at this year, number of gold stocks are up maybe 100% year to date. And meanwhile, as we mentioned before, gold's up, a small fraction of that, 25% or so. So why is it that gold stocks are more volatile and a lot of times appreciate far greater than the actual price of gold does?
Sure. There's two main reasons. The primary reason is the leverage, and if you think of it very simple, I'll say it very simplistically so that people really get it. If you have a gold company that is producing gold at $1,100 an ounce, that's their cost. It costs them $1,100 an ounce to produce a gold. If the price of gold goes from $1,100 or $1,050 to $1,150, they've suddenly gone from a negative 50, from a $50 loss to a $50 profit. That is tremendous leverage. And all of the gold stocks have leverage, whatever their costs are, whatever their balance sheet is like, and so on. They do have real, genuine leverage over the price of gold. In addition to that, however, there's also the fact that the stock market tends to look ahead. So people buy gold stocks because they're optimists. I often like to joke, but you wouldn't buy a gold stock if you weren't an optimist. But people are looking ahead. So if the price of gold today, if the price of gold, has gone up from whatever, from 1050 to, 1330, that's what the price of gold today is, 1330. But if you buy a gold stock, you're thinking, well, it's 1330 today, but it's going to be 1500 by the end of the year. You're looking ahead. And so the gold stocks build in some of that blue sky, some of that optimism. So you have the real financial leverage, plus you have the blue sky. And that's why the gold stocks tend to do better, tend to outperform both on the upside and the downside, unfortunately.
And should people be concerned if they view the general stock markets are somewhat overvalued, and if there is a decline, that will somehow impact gold stocks in general as well?
It's a good question. Gold stocks are both gold-related assets and their stocks, right? And they can react to both gold and they can react to the stock market. What I have found, generally speaking, is that if you have a sharp pullback in the broad market, gold and gold stocks will tend to go up if they were relatively undervalued beforehand, and they will tend to go down if they were relatively overvalued beforehand, and they will go down with the rest of the market. I think the worst situation, and the other factor would be if it's a very sharp break, then everything tends to go down. Expensive stocks, cheap stocks, gold stocks, everything goes down if it's a sharp break. But if it's a longer, steady decline, you often find investors looking for good opportunities. And if gold holds its own, then people will typically move into gold stocks. It's interesting where we are right now, because right now, last year, all of last year, I could say I'm not worried about that because, the gold stocks have started off cheap. I think if we have a stock market break, the gold stocks won't get much cheaper. Right now, after we've had the run, I think investors should be alert to a sharp break in the stock market. That would probably hurt the gold stocks, at least initially. But then the other factor, of course, that comes into play is why did the stock market, go down? Why did it crack? And what frequently happens, of course, is everything goes down when you have a stock market crack, and then 2 or 3 days later, gold goes up because people realize they need insurance. And the gold stocks sometimes follow that, or often follow that, but with a lag.
Well, let's talk about silver a little bit. We mentioned briefly about silver. It's up more than gold this year, probably about 45%. To gold's 25%. You had mentioned silver stocks. What is the different dynamics between gold and silver, and why should people think about one versus the other?
Yeah, no, that's a good question. Silver is obviously a precious metal, but it's also much more of an industrial metal than gold is. And there's different dynamics both on the supply side and the demand side. On the demand side, it's pretty obvious that most of silver's demand is industrial, end-use industrial, whereas very little of gold's ultimate demand is industrial. That's on the demand side, and everybody knows that. But on the supply side, a lot of people aren't aware that over 70% of silver supply comes from as a byproduct of other base metal mining. So you might have a tin mine, for example, or a lead mine that produces a bunch of silver as a byproduct. That's less common with gold. You do, of course, have copper mines, large copper mines that produce gold as a byproduct, but most of gold's production comes from primary gold mines, whereas the vast majority, over 70% of silver, comes as a byproduct. And what that means is important, because what it means is that the supply of silver doesn't respond to price signals. Because if the price of silver goes up a lot, well, the guy that's producing tin doesn't decide to produce twice as much tin so he can sell his byproduct silver, right? He produces tin and lead based on, I should be saying lead, not tin, lead, nickel. These are often mines with byproduct silver. So if you're a lead producer, and the price of lead goes up, you produce more lead, regardless of what's happening to the price of silver. So silver's supply doesn't respond to the changes in price, certainly not to the same extent and not as quickly. So the dynamics are different. Typically, however, if you look back over, 30 years or something, typically silver tends to have more leverage on the upside. It tends to move further and faster in strong markets. And there's a lot of reasons for that. There's less secondhand silver to come on the market. So whereas with gold, if you have a strong price move up, people can, go to the, you do get more more scrap coming onto the market, which helps fill the supply gap. You don't get so much of that with silver.
No,
And then, of course, the unit price of silver is so much less. So when the precious metals move, people go to the coin shop and say, I'd like to buy an ounce of gold, and they say $1,500. And they say, what? $1,500? I thought it was $400. Oh, well, I'll buy some silver instead. So people, silver's much more accessible to people.
yeah, I think everyone can appreciate that there's not this, unlike gold, this overhang of silver supply that could come on the market from scrap. I mean, everyone in their neighborhood sees those, will trade dollars for gold stores, but you never see will trade dollars for silver stores. So I think that's
no.
Knowing.
And central banks, of course. Central banks at the moment are buying gold, and I'm not overly worried about central banks at the moment. But central banks have a lot of gold in storage. Very few central banks hold any silver. And so that's another potential source of supply that exists for gold that doesn't exist for silver.
Well, and I think you brought up a great point about mine production from silver in that it'll be especially pronounced if we have, tell me if I'm correct here, an inflationary recession where you have a spiking demand for silver at the same time the recession drives down the prices and thus the production of base metals that are that silver is a byproduct of.
Absolutely. And of course, the converse is also true. If you have a very strong economy, but a good demand for gold and silver for whatever reason, let's say an inflationary but a good economy, then the production of base metals goes up, and with it, the production of silver. So yeah, you're absolutely correct there.
Well, Adrian, thanks for spending some time with us today. If you'd like, please let us know or let the audience know. If you have a website associated with your mutual fund, for gold mutual fund, or anything else, gold ETF, or anything else like that.
Oh, well, I appreciate that. Let me mention just two websites then, since you brought it up. The first one would be for our company, which is quite simple, adrianday.com, ADRIANDAY.com. And then for the mutual fund, they would have to go to EuroPacificFunds.com, EuroPacificFunds.com. I appreciate that, Chris.
All right, Adrian. Well, thanks again for joining us.
Well, thank you.